Isn't it interesting how in hindsight we see things so clearly? And so in today's episode, we're going to take that approach. It's many seasoned investors generally come to the realization that later in their career, their long held buy and hold portfolios just kind of no longer align with their current life goals or their aspirations at that point. So we're going to take some time today to reflect on a lifetime of real estate investing and discuss the importance of sitting down, taking time, and reassessing your strategy. Does it still work for you? We'll explore the clever and powerful tool known as a 1031 exchange, which allows us to pivot from earlier mistakes and just rebuild a portfolio that better suits our evolving needs, that fits our lives today. So look, if you're looking to downsize, diversify, or simply realign your investment goals, today's episode will provide actionable insights and inspiration for your journey ahead. It's a great episode. Just let's get straight in. Well, Clark, it's that time of the week again. It's podcast time. How are you doing, buddy?
I'm great. I just did 10. Sometimes we have to like loosen up a little bit. You know, we tend to talk about a lot of things, and right now it's a bit of gloom and doom out in the media. So we both just did 10 jumping jacks, and like, all right, we're going to talk about some fun stuff today. So I'm ready. I'm feeling loose. I'm flexible. Let's do this, David.
No, it's funny. We genuinely did just do 10 jumping jacks to get our blood flowing. We're recording this because there's a sense out in the market right now, Clark. You know, real estate's just not sexy right now, right? There's not YouTubers out there talking about their new bird deal that they just bird $30,000 out of a deal. You know, there's a lot of people in the media talking absolute doom, gloom. There's fear out there as we enter a kind of more normal real estate market. You know, inventory's up by 65%.
Yeah.
Well, of course it is.
Yeah.
Because it was historically low.
Yeah.
Prices are down 4%, 5%, 10%. They're up 40%.
David, I saw an article that said that like the top 10, biggest decline in markets, right? And we're in Tampa, so I'm always just interested to see what it says. It's not going to make me feel one way or another. And it was like Tampa was like the fifth highest market to drop in the last 12 months. And it was like Tampa's down like 4 or 5%. And I'm like, Tampa went up like 48% a year, for like year over year for like 2 or 3 years. Like that's so like misleading to be able to say, oh, let's doom and gloom, like let's pull out of Tampa or let's pull out of Austin, right? They said Austin was one of the top markets. Well, Austin's prices went through the roof. Like there's nowhere to go but down.
Yeah, you know, imagine on YouTube, let's say every night, you would go home, you work all day or whatever it is you do, and you went on YouTube and there were just doomsayers because Apple stock went down by 2%.
Right.
Or 5% or 10%.
Yeah.
Does that mean that you're out? You're done? It's just not how it works. It's not realistic,
it's
right?
Like NVIDIA. It's NVIDIA, right? Are you going to sell all? You think that AI is dead in NVIDIA because it had a massive loss? Is everyone bailing out of NVIDIA? Or are they like, I think NVIDIA is probably going to come back pretty quickly?
Because real estate is just not, it's just not something that you go home every night and watch blood on the street videos. Look, the bottom line is real estate is like everything else in the world.
Right.
It's based on supply and it's based on demand. And those things are always fluctuating against each other. You know, I would argue, and I could argue, that the very worst time ever to buy real estate was 2.5 years ago.
Yeah.
When everybody's out going nuts trying to do the massive deals. And you could argue that case. That was whilst everyone was feeling the most buoyant, the most joyful, and ambitious. that arguably could have been a wrong time to buy.
I think we're seeing a lot of 2022 purchases right now where if people are trying to sell them for whatever reason, is it's going to be very difficult for them to sell and even kind of get their money back. But that let's get in a time machine and go back 2 years ago to the media, to YouTube. No one's walking around saying prices are falling, the sky is falling. Yet it was it now that we're able to kind of get into a time machine and look back, to your point, it probably wasn't the greatest time. But if we were in the moment, you're feeling it, everyone around you is investing. And guess what happened? Maybe it wasn't the best time, but then look where we're at right now, David, in this time.
Hey, I got 4.25% investor interest rates on some of my loans, so that was the asset. That's what I was buying. I
Yeah.
was buying low debt. That's what
Yeah.
I was buying. The houses are just simply the vehicle. And so this is what we're going to talk about today. We're going to talk about the sense of, maturing and growing as a real estate investor and detaching yourself a little bit from what's happening right this minute, you know, what the media is saying, and looking kind of a little bit more holistically at the journey of a real estate investor, right? And so, and then we have kind of a little bit of a hot take at the end of our discussion here, because real estate is simply not sexy. It's just not. Unless you've got bags of money and you can buy unlevered real estate
Yeah.
that you don't have to put tenants into, right? You're not going to rent this thing out. It's just for you to look at, and you can get interior designers in and have it as one of your repertoire of vacation homes that you just hold. That would be nice,
Yeah.
right? And very, very wealthy people often do that. But the people listening to here, they use real estate investing as a utility. And so real estate investing is a journey. And I'm 52 and I can look back at that journey, right? We talk a lot on the phone with investors, Clark, at different stage of the journey. And so today's episode is more of a review of our portfolios, our experience with other investors, and then kind of seeing where we are now. Like, where really are we now, right? In the big picture of things. We're not in the YouTube videos holding our mouth wide open with blood coming out of our eyes, telling everybody that the world is upside down. I did a social media post yesterday just about um, how much inventory the new home builders are selling right now.
It's
The
nuts.
new home builders are gangbusters. They have got every single buyer in the market right now is going to the new home builders. And Clark, your very beautiful partner works in a home building world. Tell me real quick about the year that she is having in real estate sales, where she works, what she's doing, and tell me what her year looks like in her world. Just give me a minute.
Yeah, and she would appreciate the very beautiful. I agree with you. So I have my girlfriend of a couple of years, and she's worked in the new construction industry for almost 10 years now, right? So she's kind of only seen it just kind of generally go up. But as I didn't know a lot about new construction in terms of sales, but it's not the same product as like a resale, as a 1965 house that's all fixed up or not fixed up, right? Usually they tend to be out in suburbs where you have the larger builders, because the larger builders only want to build in PUDs where they can go out and, plat a 200 unit community. They don't want to do scattered builds where it's one house here and one house down the road. It's not as scalable, right? But after walking a day in the life of her shoes, we're talking about a bit of doom and gloom in the media right now, yet she is having her best year in her entire time in 10 years at a large, kind of like a regional builder, Lennar Homes. And she's having her best year, David, and she's been doing it 10 years, right? We're talking COVID. We're talking about it was bonkers during COVID, and yet they're still selling. But guess what? There is no competition right now. If you can imagine going out, David, and trying, let's just say you're a first-time home buyer. I don't care if you're an investor or not, right? Would you want to go out and buy a 1976, house with a nice kitchen in it, right? You're not that sure about the plumbing. You're not that sure about the electrical, but quote unquote, it seems fine. It's in a decent area. Or with, let's say, a 6.5% interest rate. Or you can buy a brand new, shiny, house in a cookie cutter neighborhood where all the yards look the same. And, there's a nice HOA that keeps everything up. There's a nice sign when you drive in the neighborhood, and you can get like a 4.5% interest rate. And you're able to buy at almost the same price as these resale homes. And they're giving you every single reason, closing concessions, help. They might as well be giving you like free steak dinners at this point. And that is what we are seeing on the new construction side. And it doesn't matter if you're an investor, you're going to pay a little bit higher percentage, but you're still getting a lower percentage than if you were going to go out and just buy a resale house. Oh my God. Like, I want to stop what I'm doing right now. We've talked about this, about I just need to go to the suburbs, find something for 300,000, reverse engineer a $2,300 a month rent. And if I can break even, that rips away all the maintenance. Tenants want to live there. Property managers want to manage that stuff. They're going to very rarely get phone calls with rental problems, faucets breaking. It's brand new, right? You're going to have the occasional problem, but on the whole, not much, right? You're going to probably have good neighbors. David, what is not to love? And we are in the doomsday media, yet these home builders can't sell these properties fast enough. It is bonkers.
Hey, you've just said it. She's having the best year ever, and it's a big year, right? You just told me about a client got a 4.25% rate, 3% down, and then they're paying all closing costs because they own the lenders, they own the title company, they own everything. The builders do, right? They have their own ecosystem, and so whatever demand is out there, and it's really big demand, it is going to the new home builders. So the supply on the in-town properties. Now, we have got great friends of ours who are super duper flippers. They do gorgeous work, and their homes are selling in 3 or 4 days right now, in all of the doom and gloom, because they're good streets.
Yep.
All of the landscaping is done, the fencing is done, there's no corners cut. You walk in, these are designer properties, right? This could be like a 1975 block home. But you walk inside, you feel like you're in a hotel, right? The people doing those deals are still selling them, right? Absolutely. But I'll tell you who's not buying. Right now, an investor, by and large, is not going out there, and they just can't make the numbers work on a 7.5 to 8% loan. And because the lenders, that's where they are. Let's say it's 7.5%. Let's say it's 7%. With insurance, your HOA, with if anyone's out there thinking the rents haven't softened a little bit. Rents went from, just I'm going to take a target market of mine. Rents went from $1,700 a month in 2020, just before COVID, let's say $1,750, went all the way up to $2,500.
Yeah.
In the space of 2 years, right? They're back down to, 2,000. They're still up, but the edges, the insanity is wearing off. And so people who 2 years ago were underwriting $2,400 and $2,500 a month in those deals, they're finding that their rents are gone down a little bit, but they do have good rates.
David, I want to interject one thing on that as well too. Is that if you are just listening to this and you're like, all right, I want to buy something and rent it out, right? Okay, so the rents have softened, just as you said. Another huge difference is, right, is it's probably going to take you 30, 45 days to get that thing rented up, right? So before, let's say it's 2021, it's 2020, whatever, not only were you getting higher rents, but they were also renting in like 12 seconds. So your vacancy percentage that you built into your pro forma, maybe 3 or 4 or 5% at most. Now you need to probably be building in 10, 12% on top of the lower rent, right? And so that combined with your 7% that you were just talking about, it's damn near impossible right now.
Right. And so all of this kind of leads us to, what it is that we're going to talk about today. As an investor, there's a sense right now that you can't really move forward, right? There's a sense right now that real estate itself was a bad idea to begin with. And so more and more and more, our listeners, when we talk to them, they really split into two groups. It's like super optimistic people that just see it differently, and they look at everything in long term. So, I'll give you an example. If you're a 35-year-old right now, and you're starting out your first deal, right? You're all thinking now. That's what you're thinking. You're like, oh, I buy it here. I'll adjust my risk profile down to what I consider to be very low risk. So I'll buy a cheaper house, right? I'll buy it in a kind of less expensive neighborhood, where it does cash flow, right? Because I know I've got to invest for my future, right? So that's, what your 30 to 25 to 35-year-old is doing, right? And this is as old as the hills, this behavior, right? When we're starting our investing journey, and this is the start of this conversation then, when we're starting our investment journey, I would say 99% of investors start out buying that cheapo property with the 20 grand down payment and the it's renovated a little bit, it's turnkey. They get the house is $100,000. They take an $80,000 loan on it, and off they go. They're at the races. They've got their first deal, and they've used up one of their 10 golden eggs. Your golden eggs being you have 10 conventional loans available to you.
David, can I describe it in one phrase? Ready?
Yeah.
Oh, it's okay. I'm not going to live here. Right. That one phrase describes, I think, the 1 through 5 houses that you first buy, where it's like, yeah, it's fine. I'm not going to live here. I don't have to live here. So I'm sure other people that are great tenants are going to want to live here, just not me. Right.
I'm going to flip that one on your head. I've heard a lot of people over the years ask me, so I'm investing, I'm getting started, I'm buying my first deal. I really want to buy somewhere where I would live in. I'm like, well, where do you currently live? So, well, I live in San Diego, in, La Jolla. I'm like, okay, well, you should buy in La Jolla if that's where you want to live, It's like, no, I don't really mean it like that. I'm like, well, so you are going to buy something that you don't necessarily want to live in. That's the compromise, right? They're investment homes.
Yeah.
I can tell you how many of my investment homes that I want to live in, right? It's a big fat zero.
Yeah.
I live in the house I want to live in, and I rent out the houses I don't want to live in. Because if I did want to live in any of my rental homes, I would now live in them, right? So my point, anyhow, is that we start off with this kind of very limited approach. And it might be because we just have $20,000 to put down and we want to get started and we want to learn on something small. There may be that. This isn't a mistake that people are making. All we're saying is this is a absolutely natural step one in our evolution as real estate investors. Now, look, there are exceptions to this. There are people who I call them accidental landlords, who will always buy their first home somewhere where they want to live. Okay. And so they live in it, but then they meet a partner, they get married, they buy a house together somewhere else, and they keep that first house that they wanted to live in as a rental, as their first rental. It's kind of accidental. There's a great house, a great apartment or whatever,
right?
Great neighborhood. And so they keep it. And that's their first one. But guess what? Guess how frequently their second one looks like that? No. Their second one's in like Springfield from The Simpsons, right? They buy in Springfield from The Simpsons. And we kind of buy that first home, and we get a property manager, and then we do our thing, right? And then we buy a second one. We're doing well. We kind of like this thing, we buy a second $100,000 home. And fast forward to a conversation I've had a couple of hundred times, which is I'm talking to people and they got 9 houses, right? And they got like one golden egg left, let's say, right? And they're looking back at their portfolio that they've bought. And this is as you get a little bit older. And I kind of realize, and this is where this episode is going to get interesting. They kind of realize that the portfolio that they have built that was kind of designed to fix their 30 to 35-year-old mindset, their 35-year-old problems. They're now 50, right? 15 years on, right? And this portfolio now is not fixing their 50-year-old problems. The portfolio was built to fix your 35-year-old problems, right? But at 35, real estate is not going to free you.
No.
You're not going to live off your cash flow unless you're doing it at massive scale. But if you're buying one house, even one house a year, for 10 years, you've got 10 homes. You're not retiring on the income from those 10 homes anytime soon, or ever, for that matter. Real estate is a wealth builder. Okay. And so folks start off, in their early 30s, and they're responsible and they're starting to invest. But then the kicks in the face, Clark, the roofs, the tenants, crazy town. Just for a minute, let's diverge for a second. Like, tell me what entropy's away. What happens over that? You start off at 35 as an investor, and now you're 50, right?
Yeah.
Where's your head at now?
Well, I think the thing is that because you're buying these lower end properties, right? They're in the lower end neighborhoods, and they kind of tend to get frozen in time. And it's easy for me to talk about it because I've got a lot of them. I've got 10 or 15 of them, and I'm trying to figure out what to do with them, right? And you're like, all right, there's the neighborhood's going to get better, which means the value is going to go up, which means the rent's going to go up. And right now, I think everybody's rent has gone up. So we'll use Cleveland, Ohio, right? I guarantee you that Cleveland, Ohio's rent over the last 3 or 4 years has gone up with everyone else, right? Now, it hasn't gone up. It didn't go from 1,000 to 2,000, but it may have gone up from 900 to 1,250 pretty quickly, right? Which is a huge rise. But the neighborhood is still kind of shitty, And what happens is that roof is still old. It doesn't care how much the rent is. And the challenging thing is that the neighborhood is still kind of shitty. You're still getting very transient tenants. You're still having to spend money on things that don't bring any value. And I am knee deep in it right now, where I've had to fix roofs. I've had to take out trees, like big tree. I had a big tree fall on one of my rentals that I paid like 15 grand for like 7 years ago. So $5,000, David, I got a bill for $5,000 to remove a tree. Now, all the tenant is pissed off because they got a freaking tree that landed against the house and it created a small hole, right? So I've got to spend $5,000 to remove a tree because it's big, it's got branches, there's probably liability. We can't just get some handyman guy in there. We need like a proper company that has the proper workman's comp. $5,000, tree gets removed. Then I got to go in and fix the roof, fix the ceiling. And oh, by the way, this whole time the tenant is not happy. And when I finish with my $7,500 quote unquote investment in the property, now I have a tenant that's like, they took forever. What? So not only did I spend $7,500, my property manager's annoyed because I wanted him to get another quote on the tree because I'm like, $5,000, that sounds like a lot of money for the tree. I'm not a tree expert, but can you please get another bid? So then now the tenant's mad, property manager is mad, and all said and done, I now have, let's talk about the finished product, right? Tenant is either neutral or pissed that they had to deal with it. Property manager is not happy. I just spent $7,500. The value of the property went up exactly $0. and the value of the rental, I can't go back to the tenant and say, hey, I need another $200 a month because now you don't have this tree. So it's like lose, 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 lose. Now, David, to your point, what if you have 9 of these, right? And they don't all happen at once, right? It's not like I think a lot of people fear that quote unquote landlord story that I just shared with you happens like every day. It doesn't, right? Like it doesn't happen every day. But I just ripped out 2 years of cash flow on that property to not give any more value to it. Now, guess what's going to happen in 5 months or 8 months? The next type of property, the same asset class, I'm going to have something else, right? That's probably going to rip the cash flow out of that one for 2 years. So if you can imagine, if you are hearing this and you're like 7 or 8 years in, maybe you've bought consistently, you're like debt by time by scale, David, right? I'm buying a house a year. I'm feeling good. And then you get out, you've been doing this 10 years, you start stretching, you're like, let me look and see how this portfolio is done with these cash flow monsters, right? Because you only have to put 20 grand down and they're going to cash flow. And you're like, shit, I really haven't made that much money. And they haven't really gone up that much in value because the neighborhood still sucks. Okay. People are, still park on their front yard and there's still a bench press on the driveway. What do I do, David? Like what, if you're listening to this and you have this type of portfolio, which I am guilty of it. I've improved over the years, but I still have got this baggage, right? This baggage that just follows me around and it kind of smells bad. And the smell, I throw, the air fresheners at it and it still stinks, David. I know people are listening to this and they have some of those problems. I want today with you to be able to put some smiles on faces, right? I want some people to walk out of here with joy. I want people to feel the way I felt after I did 10 jumping jacks with my dog on my shoulder, and it's fun, right? It's like I'm happy, my dog likes it, I'm jumping around, we're having fun. David, help the listener. How do we put some joy on their faces after they just wrote a $5,000 check for a tree to be removed from a pissed off tenant?
Well, you've heard the term misery loves company, right?
Right.
So first and foremost, you are not alone, right? And I'm talking to you, the listener. You are not alone.
Yeah.
I would say the vast majority of people who have taken real estate seriously in their lives, and I mean the vast majority, even the names and the faces you see on podcasts and social media, they all have this portfolio lurking around in the back of their lives, right? And I would much rather have that portfolio for a start than not.
100%.
That real estate portfolio that just cost you $5,000 the other day, not 3 days ago, I just put a roof on. I got a small house, got a quote for 10 grand. The invoice came in for nearly 14. Why is that? Well, underneath the
Bad
roof, all
decking.
the wood was rotten,
Yep.
so you couldn't see that with their X-ray specs. And so $14,000 roof that I got invoiced for yesterday. No joy there, right?
Mm-mm.
Um, my tenant is going to pay me $0 more for that roof, just zero. And so we get to this point as real estate investors, right, where these 35-year-old problems that we were fixing when we were 35 and 37 and 38, it's kind of almost like a scarcity mindset that you are dragging forward into your life, right? That the actions and decisions you made then, while I would so prefer to have made the decisions you made,
Right.
right? Here you are, you're 45, fair play to you. You have this portfolio and you've got all this knowledge and all of this experience, right? So, pat yourself on the back. You're there, but you're also carrying a portfolio that brings you very little joy. It is not fit for your purpose at 50 years of age. It's not what you want to own. It's not where you want to own it. They're not the tenants you want to be renting to. These are not even the property managers you want to be dealing with, right? And so later in life, it is absolutely just a natural evolution. like a caterpillar turns into a butterfly, right? There are evolutions for real estate investors. And one of those evolutions is you review at a certain point and say, you're running. It's like the Forrest Gump run in the movie Forrest Gump. And he's running and he's running and running. And then just at one point, he just stops in the middle of the desert. He's like, I'm done running.
Yeah.
And so when that happens, and why we talked about the current market conditions, is that run seems to stop when the joy inside the market and the excitement and the social media and the YouTube videos and all of the, buy, real estate's amazing. And all the 20-year-olds are hopping on and saying how incredibly busy they are and successful they are. Well, we get to this point in the market cycle and we start looking back at what we have bought in the last 12 years, 15 years, 7 years. We start looking at our portfolio. I really like being a real estate investor. I've learned a ton, but I don't want to own these things.
Yeah.
I just don't. They're not doing it for me. Like you say, they're not in neighborhoods that are appreciating. They're not in neighborhoods where rents are rising, right? So we evolve, right? But we want to keep on buying real estate because as we evolve, we very much understand, and particularly for us, or if you have one earner in your house or an entrepreneur and you have somebody else that you can designate a real estate professional, you can take bonus depreciation. Almost everyone I know buys real estate for other reasons, and it is capital appreciation is very much part of their dynamic as we get older, right? They want quality assets, really high quality assets, so really high quality tenants. They want basically newer inventory, and they'll take older inventory as long as it's in a grade A neighborhood, right? And they're doing it largely to offset taxes, appreciation, and obviously amortization. And the only place that becomes worthwhile in hindsight is in essentially Class A neighborhoods. It sounds so counterintuitive because so many, as I say, investors starting out with a very scarcity mindset, like, oh no, I'm buying for cash flow. That's the only purpose of real estate is cash flow and being defensive. Well, I would tell you that when I go out and I talk to experienced investors right now, they're offensive in their approach to buying real estate. They're like, the more experience you get, the more offensive you will become in your decision making. And I know a lot of people out there who are buying real estate, subsidizing this stuff by $1,000 a month.
Yeah.
But they're buying in coastal California. They're buying somewhere where, you might get a dip here, there, or otherwise, but over a longer period of time, they are banking on future price appreciation. But that doesn't, you might want to do these things, but you still have this, portfolio of, scraggly ass cats. They're always pissed off and angry. They're smelly. These mangy injured cats are still in your life. It's just this portfolio is not what you want in your life. It's stressful. It's super hard to just get these calls. You can see what's going on. They're not kicking you in the nuts all the time,
right,
to your point.
Yeah.
Right. But it's just not fun anymore. Right. You could get emotional when you are 50 and you start looking back at this portfolio that you own and you want to start making these smarter decisions to the point that we just made, right? And so you buy your first nice property, then you might buy your second nice property, and then your portfolio, then you can see how quality behaves, and then you can see how lack of quality behaves in your portfolio. And so you've got these finely groomed pedigree dogs on one side, and you've got your bag of mangy cats on the other side. And this, again, is very normal. right?
Yeah.
And so investors tend to get a little bit emotional about it because they realize like the entire concept that they were working with when they were 35 or 30. It's like, oh, I'll buy this $200,000 house, and I'll buy another one, I'll buy another one. They realize that whilst that was fit for purpose when they were 35 and it aligned with their goals, but now they're 50, they're 15 years older. They've had more success in their careers, they've had more success in their jobs, they've had more success in their businesses, they've accumulated more, and they've moved on
Yeah.
from the portfolio that they own. And so this is just an interesting realization, Clark, that when the market shifts, the market becomes a little bit more negative, that I'm having more and more of these conversations. David, I've got these 9 houses, kind of want to sell them. And what do you think? And here's my hot take. This is why the 1031 exchange exists. It literally exists for this purpose, right? For an investor who wants to change their strategy midstream. So I'm not 85, 52. But a lot of the initial investments that I made, a lot of initial investments that you made, and a lot of initial investments that a lot of my clients made, they were great for the time, for where we were, right? And they'll be great for a 35-year-old right now.
Yeah.
But the bottom line is this scarcity mindset when you're younger just transitions to a more mature position. And then you want to start upgrading your strategy into a portfolio that's kind of fit for purpose, where you are in your life, right? For where you want to be in the future. And so the 1031 exchange, and I think a lot of people will know what it is, but a lot of people don't really fully, I think, appreciate even why it exists. And this podcast is all about why, not how, right? It's understanding a 1031 exchange is one click away on Google. All right.
Yeah.
But why do people do it? People do a 1031 exchange, Clark, for property consolidation. The reason why people have these regrets is because they have matured. Their financial situation has matured. And so the take here is this is why the 1031 exchange is there. It's there so that you can take bonus appreciation, you can take your current mortgages and move them and upgrade them to a portfolio that meets your demands and meets your aspirations now, which may be more appreciation and less cash flow, right? It may be that you want to take all of your equity and take very minimal loans and live off cash flow. You can 1031 exchange for cash flow purposes for sure. But the reason people do 1031 exchange are as follows, Clark. Property consolidation. They want to take those 12 or 13 or 18 or whatever it is, bag of cats, and they want to consolidate it into 3 or 4 just high quality assets that they can be proud of, that they can bequeath to their spouse, that they can leave to their kids. Nobody wants to leave a bag of mangy cats to their 18-year-olds or their 25-year-olds, Lord forbid. Your kids will sell it to a wholesaler.
Yeah.
Your kids will give that stuff away because they just don't understand it. They don't know how to manage it. And so property consolidation is a big part of it. Instead of having 18 homes, they just want to have 3, right? For a lot of people, it's increased cash flow. They're just sick and tired of the trees falling on their homes and a roof giving in. Let me just buy something nice and clean. Almost like the new home construction we just talked
Right.
about at the start, right?
But it's David, it's real cash flow, right? It may not show up as much on the spreadsheet or as sexy, but then once you own those 9 mangled cats, right? And you're like, God, I got to take this damn cat to the vet like every other day. You're like, I actually don't make any money in this, right? But that's the ironic thing is you buy the assets that maybe don't cash flow as much, but you also have like a tenth the problems. And at the end of the day, we look at not what the top of the page says in terms of like a profit and loss statement, but the bottom, right? And if you're constantly having to take that cat to the vet every 15 minutes, that's expensive, right? Those vets, they're not for profits, right? But if you exchange it into the higher quality assets, ironically, you end up making more cash, and then you end up getting higher bumps, rent increases down the road.
And that's the observation I'm going to share as well. Higher quality assets just perform better. That's my experience. I'm not saying there's no scenarios where they don't. I'm saying by and large they do, right? So consolidation is a big motivation to getting out of your, we'll just murder the metaphor at this point in time. Get rid of the bag of cats and consolidate into your, your pedigrees, right? Increase cash flow. Because to your point, you don't think that these homes, these more expensive homes, cash flow, but I can tell you that we recently did a deal where something similar, very high quality asset, with a really high quality ADU, over $1 million deal. It cash flows like crazy as $1 million deal, lots of bonus depreciation, and it's just a house with an ADU in the back. It's not I could have equally, and this wasn't my deal. This is just a deal that I partook in. The buyer in that scenario could equally have bought, a quadplex,
Yeah.
in a crappy neighborhood. Now they'd have 4 tenants and 4 this and 4 kitchens and, 8 bathrooms and tenants moving in, tenants moving out. But they went for a much higher quality asset, rented out right away. The back unit rented for 28, the front unit rented out for nearly 6,000. So much easier to manage those two assets. So, they can produce higher quality assets, can and do produce higher cash flow, right? You get higher levels of tax benefits. You may also have more of an aligned geographic locations, but you may want to own property in a neighborhood that's near your house. The irony, again, is that when we start investing in all these far-flung markets, and this episode is about the journey, right? The irony is that we invest in these far-flung markets, but we consolidate. And quite frankly, I know a lot of investors who, get to 50, 55, 60, and if they can't walk to the investment home, they're not buying it. If they can't walk there, it's like, if is it in my neighborhood? No, I don't want to know anything about it. And that's very normalized, Clark, right? So geographic location is a big part of the motivation for a 1031 exchange. We mentioned estate planning. Your kids don't want a bunch of mangy cats. They just don't. And so this podcast today is timely because a lot of you out there can recognize what we're talking about, and you can feel a little bit trapped because the market right now is not going to let you out, right? Without taking a little bit of a haircut. You've got tenants in there.
Yeah.
You have this going on. You got that going on. The market's not super bubbly right this minute. I know that there's a lot of investors, from talking to investors, they want to move forward. They want to be doing stuff, but they want to take care of this headache first. So for somebody that's out there and that's thinking about their portfolio, and they really love to just realign the whole portfolio and move forward with their lives, it's natural, I think, for people to be, no, I'd have to pay taxes, or I'd have to have depreciation clawback, or I'd have to have this or that or the other. So all the reasons why not. But we're talking about regaining and reestablishing joy, and the joy of owning real estate. And in our case, we've moved beyond that again, in that we have heavily leaned into private lending, because that's a whole different level of joy.
Yeah.
It's way more joyous. We don't have to worry about tenants, toilets, roofs, trees, mangy cats, or anything like that. We are just looking at pieces of paper, essentially. We'll expand on that a little bit further. But what advice, Clark, do you have for somebody who's sitting on 9 units or 16 units that just don't fit their aspirations, and they would love to just let me draw a line under this and restart, reestablish, to do things that are more aligned with my 55-year-old goals, not my 35-year-old goals. What advice do you have for people?
The easiest advice that I can give, and I'm giving this advice to myself. So I'm glad that I can see myself in this reflection of this screen, because I'm talking to myself just as much as I'm talking to you, the listener. But let's just say that you have 6, 8, 10 mangy cats, right? And those mangy cats, some of them stink worse than others, right? Some of them only have to go to the vet once a year, and some have to go every, weekly. So my advice is that I have rentals with 5 or 6 different property managers in about 5 different markets. So for me, it's easy for me to speak about this because this is kind of what I'm currently looking at, is like, what are my bottom 3 or 4, 5 properties that I have that aren't in up and coming neighborhoods? Like, I've owned them now for 5, 6, 8, 10 years, and I go there and they're frozen in time. So if you can look at your property and say, is this neighborhood frozen in time, right? Is the same dumpy house that was across the street 8 years ago still there? Okay, that's a big red flag, right? Because that means that there's not a lot of interest in the area. There's not a lot of enthusiasm, which means that there's probably not amazing schools around there. There's not a lot of growth. There's not a lot of energy bringing to that neighborhood. That's a huge problem. So the first thing I'm looking at is, has the neighborhood, evolved over time, or is it stuck in a time warp? Okay. The second thing is that I don't care if you went from $1,000 a month, then COVID hit and it went to 1,200 and 1,500. At the end of the day, that's only looking at the top line, right? You need to get a profit and loss from your bookkeeper, from your CPA, and look at the real story. The real story is the number at the bottom. Okay. So if it's gone up in rent, great. But if you're constantly replacing all that, you're like slowly rehabbing that old mangy cat, right? And you put on a new roof this year, and then in 2 years you got a new AC coming, and then you got a septic tank, right? At the end of the day, what does that say in terms of bottom line, how much money you actually make? And if you see a trend over 3, 4, 5 years, God, I'm only making like $2,000 or $1,000 a year on these properties after I net out all my expenses, all my repairs, all my vacancy, because the tenant, I keep doing a turnover, and then I have to spend another $3,000 to be able to put in the new tenant, right? And I'm not really adding value. I'm just painting and cleaning and fixing rotten wood, and I'm fixing holes in the wall, right? If you see a trend where you're just not making any money and it's in a neighborhood that's not going up, well, that needs to be one that you need to add in, is like, okay, do I want to start selling off 3 or 4 of these? And whether that's in a package, okay, to an investment group, or if that's just individually letting the tenant move out, giving it to a realtor and letting them list it on the MLS, that you need to look at it. And it's I think if you chunk it down, right, and you say, okay, I'm not trying to build Rome in a day, okay, I'm just going to start building, and I'm just going to start building a foundation, and I'm going to choose the three dogs of the portfolio, and I'm going to see who has the worst neighborhoods that aren't performing, see where the tenant, I just can't keep getting a right tenant in there. So there's a lot of vacancy and there's a lot of repairs. Those are the ones that I would say, I'm going to put a check mark next to them. What's the next step? How do I need to sell those? So probably want to talk to a broker in the area, maybe put them together and send them out through like a wholesale off market kind of thing on an as is, to compare and contrast going the traditional route versus the kind of all cash route. And then you just focus on those 3. That's it, right? And then once you've sold those 3, then you can employ some of those methods that we've talked about. And David just mentioned about the 1031, being able to take that money, and at the same time, you're identifying assets that you could then roll that into so you can defer the taxes. So I think that it's easy for me to speak about this, David, because I'm knee deep in it right now. And I need to really focus on finding the worst of the worst, because I would much rather have, even a break even asset, a nice triplex. Even if I sold 5 houses to get to a really nice triplex that broke even in a good part of town, I'm doing that all day long, because that's going to start putting joy, right? We spoke about that earlier in this episode. It's going to start putting joy because it's going to be less problems, happier property managers, happier tenants, happier values going up much quicker, happy rent increases going up much quicker. And it's ironic because you kind of took a little bit everyone through the life cycle, like the 35-year-old versus the 50, right? The 35-year-old, it was funny. We were talking to Brian Lubin a couple weeks ago, and he was like, yeah, you go into the RIA meetings, right? And everyone's sword fighting over how many doors you own, right? And it's ironic how it's like you want to puff your chest up and say, oh, I have 10 properties or 500 properties, whatever it is. And then as you kind of evolve, you're like, oh, I kind of want less roofs and less tenants and less problems and just higher quality assets. And you're almost puffing your chest out like, that guy's got like 76 C-class houses. Good luck. You're almost like, I'm good luck for you, my friend. I've downgraded to 14 like super baller A-class houses. So it's funny how at first you think that it's just door count, right? But you can't see the layer, there's that Instagram filter of all the problems, the stress, the tree repairs, the this, the that you're not going to have on that stuff. So
Right.
that's my advice, David, is to be able to really isolate maybe 3, like get something that's manageable. If you've got 50 properties, go look at 5 of them and just carve out those 5 and just focus on those 5 to trade out of those and then rinse and repeat. What about you?
I think at 52, you look back and you look at all the appreciation you missed out on because you bought in shittier neighborhoods. I say, if only I had bought fewer properties in better places, I'd have made so much more money. But it's not too late. And so the scenarios, the how, if you will, we don't often go into the how here, but a huge amount of investors that do call me, we have these chats, are really hung up on a 1031 exchange. I'm like, okay, well, I'm going to 1031 exchange this property in wherever, not in Springfield. And I go to 1031 exchange. I'm like, okay, well, getting really hung up on this 1031 exchange because there is limitations to a 1031 exchange. You've got to identify a new property within 45 days. And so if you're trying to dispo 4 or 5 or 6 of your non-performing assets, trying to get 6 of them sold all at the same time, and then roll them in within a 45-day stretch,
not happening,
and then close on them within that time frame. That's a very narrow window. It could be quite stressful. So 1031 exchange is an amazing tool, but it's not the be all and end all. So I'm going to come full circle with this podcast, in that if you have bought a property for $100,000 10 years ago, and it's now worth $180,000, but you put 20% down, so you got an $80,000 loan, right? And you've paid off 30,000 of it. So now you owe $50,000. The property's worth $180,000, right? But you've been probably fixing the roof and doing this over all of the years. So your accountant will add all of those expenses up over its lifetime, right? So you bought the property for 100. That's your cost basis, and then you might find that you've spent 27,000 on fixing crap over the years, right? So then you might actually find that your capital gain is only about 53,000, right? And of that capital gain, you might find that you only owe a 15% capital gains tax. So let's just say that is 10,000, right? I'm just plucking numbers out of the air. So don't get too hung up on the 1031 exchange. 1031 exchange is great when it's meaningful, but a 1031 exchange is a waste of time when it's like 10 grand, right? What's more important is that you can take that equity, right? So we just talked about you owe 50, you're selling it for 180, right? So that's $130,000 spread. Let's say $30,000 on the 10 grand and realtor fees and all that. So you're walking away with $100,000. So that little smelly bag of cats that you've got has still made you money, hopefully, right? But then you take that $100,000, and this is where the joy comes in. You walk right up into Lenar's office, and you meet your girlfriend, and she's going to give you a nice, beautiful 4-bed, 2-bath, brand new, with amenities and pools and all that kind of jazz in a high growth market. You're going to slap your $100,000 down, and now you're on a different journey.
Yeah.
Now you're on a journey that your kids would want to inherit that home. You no longer own that cesspit they don't want anymore. That's not growing. You now are in a more aligned position with where you want to go for the next 10 or 15 years. And so, in conclusion, don't get too hung up on the negativity in the marketplace right now, because there's amazing acquisition opportunities right this minute. But what there's not amazing disposition opportunities. It's harder to sell homes, but you're going to get a better deal on the acquisition side of it, right? But it's not that binary. It's more, it's your portfolio will always have, it's hard to buy, it's hard to sell. It's just always that way.
Yeah.
And so if you have to take a little bit of a haircut to realign your portfolio with where you want to go do it. That is my conclusion. Live your life in accordance with the way you want to live it. It's never too late to either do a 1031 exchange if it makes sense, or just bite the bullet, change course, get aligned with your, your cash flow, geographic and estate planning and consolidation goals, and move forward into your 60s and 70s with a portfolio that meets your needs now. So that's our episode.
David, I love that. And if you've stuck with us through this last hour and you're still on your jog, you're still on your drive home, we appreciate you sticking with us. What I'm walking away is, instead of looking outward, instead of here doom and gloom, interest rates, seller expectations, blah, 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 right? Get the mirror, start looking inward at what you have. So if you've been listening and you've got 5, 6, 8, 10, 15, 20 rentals, look inward, go look at the dogs, the mangiest of the mangy cats, and figure out how to take some action and start to remove those and trade out of those. And there are opportunities to be able to buy nice assets, and you will be so much happier. You'll have a big freaking fat smile on your face. And that's how we want to leave you with today. So we appreciate you listening. And we're going to continue to keep giving great content to you guys. We appreciate all the people reaching out to us and giving us ideas and questions and concerns and fears and all those different things that helps to drive the content that we're able to bring to you. So with that, David, I think that the jog has finally probably come to an end. So we'll see you next time. Thanks, guys.
Increase the joy. It doesn't have to be miserable. Thank you so much for tuning into today's episode. Look, we truly appreciate your support and hope you found the conversation insightful and engaging and useful. If you enjoy the show, because there's a lot of shows out there, would you please take a moment to rate and review us on your favorite podcast platform? Your feedback helps us grow and reach more listeners. And if we reach more listeners, we will have bigger and more interesting guests. So don't miss the show. Please go ahead and subscribe so you don't miss the next episode. We hope you enjoyed today's show. Thank you so much.
You've been listening to the Burn Your Boats podcast with Clark Lunt and David Shaw. We would love to hear from you. Please reach out at burnyourboatswealth.com with comments, questions, and if you have a topic you would like Clark and David to discuss on an upcoming episode. We would very much appreciate it if you took the time to rate and review Burn Your Boats podcast on your favorite podcast listening app, and make sure to follow and share on social media. Content in Burn Your Boats podcast is for entertainment purposes only and is not legal or financial advice. Please review our legal disclaimer at burnyourboatswealth.com. Thank you for listening.